Thank you very much. Welcome, everybody. And we've got about an hour together for those that have the stamina to stay through that long. I intend to present for about 30 to 40 minutes, and then there'll be questions via phone and the website. So thank you for your attention today. So the news that's brought us together is the signing of the rig contract for the Ensign 965 rig, which we have contracted to drill our Canyon 1 horizontal well. But I thought I'd take the time today to do this webinar to give a bit of a background, the investment thesis, the activities that we've been undertaking in about the 6 months since we had the last webinar, and then the look forward as to what's coming up with our exciting opportunity. So it's a great time because last week you probably heard that there was some encouragement given to the gas sector by the federal government, finally explicitly supporting the need for gas developments, and in particular the need out to 2050 and beyond for new gas developments to come on stream to support the energy transition in Australia. So we'll provide a little bit of context overall, as I say, and then narrow down to the specific activities. So we'll get underway. The first thing is the standard disclaimers and cleansing notices, etc. Key risk statements. I'll leave you to read those at your leisure. So the overarching thesis for the Omega project is I believe a very exciting one, and I'll explain the reasons for that in a moment. But high potential, low CO2 gas and liquids portfolio in Queensland's Taroom Trough. I'm a geologist by background, so forgive me, but I'll go into a little bit of geologic understanding because I think it's important. But low CO2, I think everybody should be aware that that is really important, and new reserves with low CO2 are going to be really critical for any gas field, potential gas field development in Australia, because you must deal with the CO2, and in this case it's a very favourable factor that this basin is generating and hosting a lot of gas and liquids with low CO2, less around the 1% mark, but that's to be confirmed by some of the flows that we hope to achieve. The Taroom Trough is in the southern part of the Bowen Basin. Everybody knows the Bowen Basin. It's been a huge impact on Australia's energy sector and, in fact, our economic well-being. And so the Taroom Trough is just a subsection of the southern part of the Bowen Basin. 2 successful discovery wells, one in each of our ATP areas, were drilled in 2023, showing the distribution of this play, presence and distribution across our entire acreage area. And significant appraisal tests, and that's plural, and I say that for a reason, because it's not just us. Ours is really significant, but also Shell and Elixir are actively doing some significant appraisal in the basin in this year. And it's one of the few areas in Australia where there is an active exploration and appraisal program going on. And that's really significant because of the urgency for the requirement to get new volumes of gas into the market. We'll talk about that in a minute. Very favourably located, which means lower development costs. That's what the bottom line is. So we're close to the infrastructure that's existing in Australia, and in particular, the offtake points for both the domestic market and the LNG exit routes up to Gladstone, where it's exported. So we have a strong technical and leadership team. I think you'll see through this presentation, we've done a lot of homework. We've done a lot of really deep, intense reservoir geology and frac development and design. So our team here is matching with any of the capabilities of any of the teams undertaking this sort of work around Australia and, in fact, globally. We have access, very fortunately. One of our major shareholders is TriStar, who have a deep experience and a really significantly skilled team that have done these exploration and developments in tight gas basins in the US and have been investors in Australia and understand the Australian context for a generation, about 30, 40 years. So we're very fortunate to have that sort of backup in a small cap company, and the technical work that's been done is top class. We have experienced, well-financed major shareholders. So two most significant shareholders who own just slightly under 50% of the register. TriStar, I mentioned, and Ilwella is the family office of the Flannery family, experienced resource investors in Queensland for 30, 40 years. And we're really pleased to have them on the register, and it's a big advantage to us as a small cap to have that patient money that is not just looking for short-term trading opportunities. They're really in this for the long term, and they believe and understand the resource sector and the potential for this play. So it provides us with a lot of stability and a lot of confidence to do the groundwork and the proper technical work to make sure that this resource comes to its ultimate value potential. And finally, and I say finally, we have some government support at the federal level to recognise that gas is an essential part of the energy mix, and it highlights that the key role for gas is not just short term, but it's to 2050 and beyond. We'll talk about that on the next slide, but that's important that the government are explicit in their support of the gas industry, because the opposite has been true for the last several years, and it provides a lot of uncertainty for investors when they're not sure how the policy settings will shape into the future. So finally, some recognition that gas has a vital, essential role to play in the future energy mix, and I'm very pleased that they've reached that point, but it's taken them quite a while, I might say. Okay, so that's the overarching investment thesis, an exciting new development area. It's got a lot of fundamental technical issues that are running in its favour, and finally we're getting some support and recognition from the policy settings. So it couldn't be better timing. The tailwinds are now with us, and we can look forward to getting on with the technical work and progressing this. So the board, I mentioned, Andrew Hackwood is the country manager for TriStar Group, and Quentin is the representative of Ilwella, the Flannery family. And then Mike Sandy, an experienced geoscientist that's seen this industry develop over a long period of time, and the chair, Stephen Harrison. So the company is well administered, well governed, and we're a small cap, but we're doing things to the highest standard. So let's talk now about the East Coast gas supply, and this is interesting. The highlights as we step through 1, 2, 3, and 4 is there is a well-publicised gas supply deficit in the East Australian gas market from as early as 2028. There's a structural deficit, but in terms of peak, it could be as early as this year, when the southern states experience some significant shortages over short periods of time. That's been well publicised. AEMO's latest gas statement of opportunities came out in March, and it's those numbers, as the charts on the bottom there, from that document. Number 2, the Interim trough. Several operators, including Shell, are actively de-risking this play, and clearly we see it as part of the solution to address that major supply gap. And that major supply gap requires 2 things. One is high volumes, and one is getting it there as fast as possible, because that is really, really rapid in terms of the oil and gas sector, the E&P sector. The lead times for all of the approvals and hurdles and the technical work to be done to do all the procurement and operations and integrate the results and then go to the next stages. Lead times are generally in the area of about 10 years. We are advantaged here because of that proximity to infrastructure, and we're trying to progress things as quickly as possible. But my belief is that in the next few years, it will become increasingly obvious and increasingly urgent that we need large supplies of gas soon. And the market will be demanding answers, and we are one of the only areas that could potentially get early gas into that market and try to supply that shortfall. On the right-hand side, let's go to number 3, proven large-scale tight gas play with multi-TCF potential. So that speaks to the scale. Number 4 speaks to the timing, near-term production potential with low-cost access to domestic or export markets. The export market reference is the slide on the chart on the lower right, where that's the supply into the LNG plants in Gladstone. Now, those largely coal seam gas or CBM supplies into that, they're developed on a just-in-time basis. You develop the wedges of supply to meet the throughput. So that dark blue of committed supply is what's developed right now and committed to supply. They will be developed and the volumes will go up a little over time. But in the longer term, they're running at about their maximum capacity now, and there already is ullage in those LNG plants. I've mentioned this before. So there's an opportunity there that goes beyond filling that supply gap into the domestic market. That is a high value opportunity because it's brownfields economics that go into those LNG plants to process that and export it. Now, Australia is underpinned by, it's an energy net exporter, and we have had a resource economy that's underpinned our standard of living in this country for many, many decades. So it's both minerals and oil and gas, but largely gas from the Northwest Shelf and Darwin and now Gladstone that have been exporting to some of the key countries in Asia to support their domestic and industrial energy needs. And so there is a huge opportunity for Australia. We should be exporting gas and earning the revenue that underpins our standard of living. And to get into the situation where we are short in the domestic market is a crying shame. But that's where we are. Now, if you look at the scales on those two charts, you'll see that the domestic market is about a third or a quarter of the scale of the export market out of Gladstone. So, you know, the only other alternative to new fields coming on to fill that gap is to divert some LNG supplies into the southern markets and regasify that LNG to meet the demand. Now, that is likely needed. It may be required for the next several years, but my hope is that with the right encouragement, we'll be able to develop these fields into supplying most of, if not all of that gap that is on your screens on the lower left chart. Okay, we'll move to the next one now. I'll take a little time on this one. It's important that it's critical to the investment thesis here, and there's a few points I want to make on this map. So I'll kind of do it chronologically so that it all comes together and makes sense. This is a map of the major producing basins in Australia and the major infrastructure that connects the basins to the markets. So this is just the fundamental energy balancing equation. Let's start with where it's kicked off. The Gippsland Basin down on the lower right, that's offshore Victoria, is a very high permeability conventional reservoir, originally hosting gas and oil supplies. And they're world-class, world-scale fields that have produced for 50 or 60 years. And they are in the last stages of their production life, which has been known and forecast and recognised for at least 20 years, where the end of these field lives has been modelled and understood for a long time. So the fact that they are declining quickly now is related to two things. One is in the first stages of their production, right through most of their field life, the oil was produced as the primary valuable commodity, and the gas was left in the reservoir on purpose to maintain the reservoir pressures to maximise the recovery of oil. In the latter stages of their field life, i.e. the last 10 to 15 years, many of those producing fields have been what's called blowing down the gas cap. So it's the final stage of taking the energy out of the reservoir. The gas is produced and sold in its own right, and the reservoir pressures deflate like a tyre on a car. They deflate reasonably quickly, which is what's driving that steep decline you saw on the last slide in the 10 to 15% per year. So that has major ramifications because in the early stages, as I say, oil was the valuable commodity. It was sold and exported, and major revenue was earned for the state of Victoria and Australia. Over decades, and the gas was basically a byproduct at that point. So it was sold into the market at prices that were relevant. You know, they were basically trying to dispose of the gas as a byproduct rather than the main generator of value. And it happened to be located near the major demand centres in Sydney and Melbourne and all the industrial base. So the industries got used to historically low gas prices, high volumes whenever they needed it, and so did the power generation. When the peaks in Victoria and New South Wales occurred in winter peak demand, the Gippsland Basin was able to turn on and off at high volumes as required and then shut down again. So that's what people have become accustomed to over lifetimes, over 2 generations. So that's the current paradigm for people's understanding, is that it's always been there at call whenever you need it. And that is no longer the case. So then we go to the Cooper Basin. That's also been around 60, 70 years producing gas. Same dynamic. First, the liquids were the main drivers of value. The liquids were produced, the gas was a byproduct, and the gas was sold into the domestic markets, into Melbourne, Sydney, and Adelaide, Melbourne, Sydney, and Brisbane markets. And so that gas was also sold as a byproduct. The main value was in the liquids. So that's when people refer to historic heritage or legacy gas prices. They were very low, $3 to $4 a gigajoule, and even lower at times, because it was a byproduct. It wasn't the main value driver that justified the field developments and all the capital intensive work that needed to be done. Then we'll step across to the Western Australia. The discovery on the Northwest Shelf and the construction of the LNG facilities was huge volumes of conventional gas, and I'll define the word conventional. It's free-flowing reservoirs that don't need any assistance to flow hydrocarbons at significant commercial volumes. So that is the Gippsland Basin, the Cooper Basin, and the Northwest Shelf are all examples of those conventional oil fields. And they are, in world scale, they've been the Gippsland and the Northwest Shelf have been major producing provinces that have been producing for decades, high value commodities that are largely exported, both liquids and gas. And in the case of the Northwest Shelf, it was exported as LNG. Big contracts with Asia, China, Japan, Korea, South Korea. And it's increasingly valuable around the world for the same reason it is now in Australia. So it's a major opportunity for Australia to earn some export revenue to underpin our economy. Okay, so the life cycle of those fields in the Northwest Shelf has still got a long life, but in Gippsland it's coming to an end. And you can see quite clearly by this map that the Western markets and the Eastern domestic markets are completely separate. So there's no way to get those conventional gas production from WA into Eastern Australia unless you import it as LNG. So now we'll go to what's coming next, because the days of conventional gas in Eastern Australia are over. And just like in the rest of the world, the new generation of significant volumes will be in unconventional gas. And in the Bowen Basin, we are bestowed with some incredible resources that are unconventional. And unconventional means that the reservoirs don't always flow unassisted. You have to stimulate them, or use that word is to fracture stimulate or hydraulically stimulate the rocks to enable them to flow at commercial rates. The recognition of the amount of gas that was hosted in the coal beds in the Bowen Basin took place in like late 90s, early 2000s. About $80 billion US was invested to build the capital, to build the infrastructure, develop the fields into the export industry that is now earning an enormous amount of revenue through Gladstone. So those coal seams were the first of the serious unconventional reservoirs in Australia. And that's been a boon for the economy and is now an underpinning of a lot of supply into Asia. So in Australia, unfortunately, the justification for the construction of those fields was based on a gas-only value equation, unlike the liquids that I spoke about earlier. So the full capital cost of all of the field developments, the infrastructure, the processing, the compression, the liquefaction and the transport had to be justified by sales of gas. And the markets that were prepared to pay that sort of cost to make that an economic proposition were the markets in Asia, where they don't have their own domestic supply. So that was the first example of a gas-only industry built on the economics purely of gas, and gas being valued as a commodity in its own right. So now in Eastern Australia, there are big requirements to replace the volumes coming out of Gippsland, and the only basins that are going to be available with those sorts of volumes are unconventional basins. So let's look at where we could potentially find those. There's two elements, two parts of the world, two parts of Australia where we have identified large volumes of unconventional potential. One is in the Beetaloo Basin up in the Northern Territory, where there is shale gas is being identified as having some serious potential. And I think that it's got a lot of potential to develop. The issue with that is that it's a long way away from the eastern gas market. And by definition, it's got a high cost base to get materials, equipment, infrastructure up there, and people to do the drilling, the intensive drilling that's required is costly. And then there's the matter of connecting the production into the East Australian demand centre where it's required. And that's very high cost to build that sort of infrastructure. And the tariffs involved in recovering that capital cost will mean that there's a structurally higher cost base to any gas that's produced out of the Beetaloo Basin. To my mind, it's well suited to go north into an export infrastructure model rather than into the Eastern Australian gas market. So now we come to the Interim Trough. That's the only other portion of the geologic basins in Australia that has this sort of volume potential. And that's why it's so favoured. It's got multi-TCF potential, the ability to produce relatively near-term, low CO2, and that low-cost access to domestic and export markets. And it's situated in an existing oil and gas provinces where we can access equipment, materials, people, skills, and services that are needed to do the intensive drilling that is inherent in unconventional gas. Unconventional, as I said, means you have to stimulate and keep drilling and creating the reservoir permeability yourself. And that means it's a constant drilling factory. So the way in which you exploit these things is really important. You've got to keep your costs down to be able to get gas out at a reasonable basis. And again, this is gas, but there's also in the Interim Trough the added bonus that there are liquids. And so associated liquids, and I'm talking condensate and even some oil in the reservoir conditions, is really valuable, and that will add to the economics and make it a lot more feasible to have an economically positive development scenario coming out of these rocks. So I believe the Interim Trough has enormous potential, and it's going to take some really clever technical work and some capital to explore and appraise the full potential of this, but the fundamentals here are certainly very, very favourable, and there aren't many options that can compete with the fundamentals that we're uncovering in the Interim Trough. So I'm pretty excited by it, and I think that as the need becomes more obvious in Australia to not only supply the domestic market, but to take advantage of the export opportunities, that good sense will prevail, and there will be support behind this industry sector to get after this in a meaningful way. So that's what I mean by tailwinds. Okay, I think that's enough high level. Let's get on to some more details. Down into the Interim Trough, what's actually happening? Elixir Energy running their Grandest project. They've drilled Daydream 2, the well you can see labelled on the screen there. They drilled down to 4,300 metres, and at 4,200 metres discovered a nice little sand that they drilled through that actually had enough permeability to flow in its own right. That was not modelled. That was a new discovery, and it's added a lot of intrigue to the basin because it just shows how much potential is in this Interim Trough. It's it may or may not be really significant. We'll see. They're doing a lot of work on that, but they're basically penetrating the entire Kayanga section, which is the Permian section that's attractive in the basin. And they're testing, I think, 6 separate intervals in that. That's their program that's being undertaken at the moment. So that's interesting. We go across to the left. Santos have quite a bit of acreage, as you can see by the names on the permits there. They're not undertaking an active program at the moment, but each of those permits has obligations for work programs to be fulfilled. So I expect in the next few years that there'll be seismic and drilling from Santos. Santos are also in a JV in several blocks with Shell. Shell are undertaking an active program right now, the Tight Gas Sands project in the little dash square there that you see. I believe they're drilling several horizontal wells, and they're employing the rig right now that we have just contracted to do that. So there's been quite a bit of activity, and this is one of the areas in Australia that's only one of the really 2 or 3 that have active exploration and appraisal going on, because these companies can see the future need emerging, as I'm explaining to you, and really motivated to discover where those new supplies can come from in Australia. So pretty exciting, a lot of appraisal, and the whole basin is an exciting place for those fundamental reasons. And with some good results coming out of this year, I think there'll be a lot of reasons for the industry to pay a lot of attention to this part of the world. So let's get into the geology a little bit. The dark shaded area there is the Permian Kayanga Formation, and just pay attention to the red chart there on the right hand side of each of those wells. That's the gas readings that were associated during the drilling of the wells. And what you can see is high gas readings across that entire interval that goes right across the basins. Those well names, this is a profile through the Taroom Trough, from the flanks on the left and the right into the deep part of the basin in the middle, and the wells that really give you the sort of framework architecture of the basin. Now that Kayanga Formation is the same in other parts of the Bowen Basin. It's the Baralaba coals come from that Permian section, and those coals have been incredibly significant in Australia's economic history. Mining the coking coals in the northern part of the Bowen Basin, and then more lately the coal seam gas that underpins a lot of the fields that are producing into Gladstone at the moment are also in those same coal seams, where they're up much shallower further to the north in the Bowen Basin. Now down here in this deep Taroom Trough in the southern part of the Bowen Basin, these rocks are actively generating oil and gas, and they are giving us, enormous storage of gas in this big container that's shaded there in the dark grey. That is the tight gas play. It's rocks that are surrounding these generative coals and some of the marine sediments. They are actively pumped up and inflated with the gas that's coming out of the coals, but it hasn't got the permeability to flow out, so it becomes what we call overpressure. So it's like an inflated band of rocks that's 300 to 400 meters thick right across the basin area. And that's what's under investigation. And that's where we think there's a very high chance that we'll unlock the key technical parameters that enable us to produce this gas economically. And it has enormous volumes contained within that. So it's a very attractive target. Not only gas, but liquids, as I mentioned earlier. So various operators are undertaking various different tests to be able to see what they can achieve. Up on the left there, Dunk, that's the play that Shell are investigating. It's not precisely in that location, but that's the element, that's the stratigraphic interval of the basin that Shell are investigating in that Wallabilla coal measures. I believe the Chinoan sands is their technical name. Number 2 and number 3 are what Elixir are undertaking.
The elixir I mentioned are testing the whole section there. They're both the coals and the clastics, the siliciclastic sandstones and other rock types around those coals that are inflated with the gas and oil. They're perforating, I think, 6 different intervals through the entire section with their vertical well. And number 3 is that deeper sand that I mentioned before. It's below the Kayanga Formation. It's called the Laurel Sandstone, and that's provided some flow without any assistance or stimulation. So that just shows that it is possible that we've got some attractive rocks down there that will flow under their own right. So number 4 is what Omega is doing. We're testing a horizontal well into the lower part of the Kayanga Formation, the Kenyan Sandstone. And we've chosen that very deliberately. I'll go into that on the next slide. But we are testing one part of a very thick sequence that has very high potential. So we're doing that for a reason. I'll go into it on the next slide. Number 5 is just a historical note. There's a well named Cabelwin 1 up on the shoulder of the basin that was a subject of exploration in the 1960s and 70s, and that well free-flowed oil and gas from that upper part of the Kayanga Formation, just to illustrate that this play's been understood for a long time, and there's a certain reason that it's now coming to the level of investigation and interest from the industry. In fact, there are 3 compelling reasons. One is we understand the rocks. There's been enough wells drilled to really understand that it's got great potential. 2 is, as I explained earlier, the market. The market is, for the next decade or 2, going to be structurally short. So that means that there's offtake opportunities and willingness to pay reasonably high prices that will support the economic development of these unconventional resources. And 3 is that the development of the horizontal drilling technology and the hydraulic stimulation technology that has been developed over the last 20 years is now commonplace in the industry. The way in which these things are applied to the basins in other parts of the world, particularly the US, these deep, tight gas plays. And in the shale industry, there's thousands and thousands of wells have been drilled using horizontal drilling and fracture stimulation technology. So it's well understood. It's been developed to the point now where the application of it is commonplace. And so those 3 aspects of an understanding of the basin and the rocks, the market is available and willing to pay the prices that are needed, and the technology that has brought the focus to the Taroom Trough. That's the reason people are excited and interested. Okay, so I'll go quickly through this, but this one is why horizontal? Why are we going horizontal? I just showed you the framework of the basins with those wells that showed the distribution of the play, the characteristics of the play. And in our view, we've learned enough about the distribution and characteristics of the play. It's a large resource. It's got lots of potential. It's demonstrated flow from those vertical wells, some of which were undertaken in the early 2010s and through to today. And each of those wells have flowed, once stimulated, up to 2.5, 3.5 million standard cubic feet a day, which is interesting, but possibly not sufficient to justify an economic development. So the next thing is, commonly these types of plays are exploited by horizontal wells. Do we know enough about these rocks to be able to confidently drill horizontal wells? Well, that's the undertaking that we made last year, to study that and to decide, and that's exactly what we've decided. The stress regime, we understand both its scale and its orientation, and it's moderate, and we think it's safe and capable of hosting horizontal wells. The overpressure, there's that inflation of those rocks surrounding the coals, is moderate, and it's amenable to high resource densities. So the rocks are filled with a lot of gas, a lot of liquids surrounding the wellbores that we intend to drill. The temperature is modest, moderate geothermal gradient. So all of the factors are pointing towards that this could be amenable to developments by lateral wells, horizontal wells,
drilled into this to expose these rocks to a large surface area of these rocks to stimulation and hence obtain commercial flow rates. So that's the key, is can we get commercial flow from a horizontal well? And that's the test that Omega are undertaking in the next few months. So it's a very exciting test. Shell are doing the same thing. They likely won't release their results to the market, however, but for Omega, this will certainly be a significant result that will be material. So we will be undertaking this in the next few months, and I am very eager to see whether or not we can get some reasonable flow rates out of this that point toward commercial production potential. And we won't answer all the questions with the first well, but if the first well gives us encouragement, the potential here is huge. So this is a very significant test of a very significant resource in Australia. This is what the well looks like. The lower solid line is a representation of our actual well path, and that's into the lower part of that Kayanga formation. The dashed lines on top are simply illustrative to demonstrate that if we're successful with the first one, there's about 400 meters. If you look at the scale on the right-hand side there, you can see the depths, or on either side, you can see the depths. There's about 250 meters in that representation, but this Kayanga formation goes to 350, or even the surrounding parts of it there's high gas content in some of the formations, both below the canyon or below the Kayanga formation in what's called the Back Creek Group, but we're just displaying the Kayanga formation here. So as I said, those coals that are the generative source rocks are prevalent throughout this section, and they are providing the gas that is currently generating in this deep basin into the clastic rocks around it. So we're drilling that horizontal well. It'll be somewhere between 300 and 1600 meters of lateral section, depending on how we progress when we actually start drilling. And then we're going to do a multi-stage fracture stimulation and flowback program after that. And the results of that will point the way towards how much more potential there is in this rocks. But the anecdotal evidence from all those different wells that flowed into the vertical wells, you're going to get a better flow rate out of a horizontal well just because of that increased exposure to the surface area of the reservoir. So it's very exciting. If we can achieve that, then we can fast track the next stage of appraisal and even early development. We've contracted the 965 rig, and the important things to note here is that this rig is a high capacity rig. It's got a high hook load. It's got more than we need to drill the wells down to the depths that we're anticipating and the horizontal sections. And probably more importantly, it's undertaking the work for Shell at the moment. So they're drilling very similar style wells at similar depths into the same rocks that we intend to. So we'll be inheriting a warm rig with a crew that are accustomed to drilling this style of well, and that's a big de-risking exercise for us. So we've been patient and we've waited to get this rig, and we're very pleased to have it contracted now and to work with Ensign and their crew that are well practiced in drilling exactly this style of well. So that's a really positive factor that was announced only last week. Now, a little bit of an update on what we've been doing. We've been very busy the last 6 months. I've rabbited on for a while, so I'll try and flip through this pretty quickly. Our resource assessment was the last time I provided a webinar like this, and that was, I think, in September or October last year. 1.73 TCF as a 2C, and the 3C was 4.5 TCF, just pointing towards that upside volume. And that wasn't even in the full breadth of the Kayanga formation. That was only in a few selected intervals. So just emphasizing the point that this is a high volume resource. And if we can unlock the commercial technology to exploit it, it's got the volume to really address those big market shortfalls. We've finalised the landing zone. We've done some deep technical work looking at the reservoir quality and the completions quality. There's a lot that goes on here in the deep subsurface science. And we believe that we've selected the most attractive option to do the first test with, and that includes both the reservoir parameters themselves, but also this very awkward sounding word of the frackability, which is the mechanical properties of the rocks to both initiate and propagate the hydraulic stimulation that gives you that increased surface area around the wellbore and allows the gas to flow into the wellbore. We've made the right, we hope we've made the right balanced decision as to which is the initial test of that entire interval. Secured the rig, the major services and long leads. Long leads are already procured. The major services, those announcements will follow imminently. Now that we've got the rig, we can lock in the major services. That's well advanced in our tendering process. The basis of design and the well program has been finalised, and we've got only a few details. We need the skilled service contractors to finalise the very last parts of that, but we're well in hand and along the path with that. Our tenure retention strategy is going well. We've got PCA applications in, that's potentially commercial area applications in. That means that we don't, if we're successful with that, which we hope we are, and we're waiting for an announcement from the Queensland State Government, that means that we will not need to relinquish our acreage on the normal schedule. It applies to an exploration block. Because it's potentially commercial area, we would maintain the title of the entire area for as long as it takes to be able to undertake the investigations we need. And finally, we're progressing the application for an R&D tax incentive, and we've got a claim that's ready to go, and that would be a good financial boost to us if we're successful with that. And the forward plan. The headline says it all. Can commercial flow rates be achieved? That's the ultimate goal of our entire program. The first thing we need to do is get the well successfully drilled and go through those elements that I've listed there. And we're well on the way towards hiring a new chief executive officer. The architect I'm filling the role and really enjoying it, I must say. And we've got some very high quality candidates that we'll be announcing when we actually finalise that. Production testing and the phasing in that after the well is drilled, there'll be about a 3-month gap, 2 to 3 months, where we incorporate the results of the well and finalise the design of the fracture stimulation. And it's not simple. You've got to get all the fluids right, you've got to get all the proppants right, you've got to get all the pressures right, you've got to understand exactly how you're going to do these things, because you're down at 3,400, 3,300 metres and you're drilling, up to 1 kilometre or more long. It's not a small engineering undertaking, and it's really important to get this right, to execute it properly, to give the reservoir the best possible chance of producing to its optimum capacity. And then long-term strategy. 3D seismic, multi-well appraisal drilling. We'll definitely be looking at reclassifying our large resource base into reserves if we get commercial flow. Full field development planning, industry engagement for potential farming partners, and conversion into a petroleum license. So, as I said, if we're successful here in this basin in general, in our acreage in particular, we'll be looking to fast track development. I hate the word fast track. We'll be looking to expedite the development in a really quality way to meet an urgent market need. And the good thing about unconventionals is you can do it in a measured way. You don't have to do a full field development straight away. You can do smaller partial developments and get some production happening, and then build on that quickly once you learn more and more about the reservoir characteristics. Okay, I think I've gone a fairly long time. I'll pass it back to the moderator for the Q&A.
Thank you. If you wish to ask a question via the phones, you will need to press the star key followed by the number 1 on your telephone keypad. If you wish to ask a question via the webcast, please type your question into the Ask a Question box. We will now pause momentarily for questions to be registered. there are no phone questions at this time. I'll now pass back to Mr. Brown to address any webcast questions.
Okay, thank you. All right, we have a webcast question from James Starr. So James has asked, assuming a reasonably successful flow, what is a reasonable expectation of reserves? And what is a reasonable timeline to commercial operations? And what would you expect as a valuation uplift for stock price? Will a further cap raise be necessary? Geez, you packed them all in there, James. All right, let's do it one at a time. A reasonably successful flow. The reserve, what was the expectation of reserves? Well, we've got, as I say, 1.73 TCF of 2C, that's contingent resource, and it's contingent on being able to demonstrate commercial flow. So I would expect that at least that would be our upgrade to reserves. But that only incorporates a couple of levels in the Kayanga formation. I think we would have a view to increasing that over time. And the 4.5 TCF is what's called 3C. That would be an upside result on our current test. So the answer to your question is somewhere between those two is most likely, but that's really significant. And then there'd be a lot more to follow once we were able to understand the characteristics of the rest of the Kayanga formation that has not yet been considered. Reasonable timeline to commercial operations. I think average in the industry for developing new reserves is somewhere in the order of 10 years to go through all of the technical work, the approvals, the development. But in this case, as I say, the opportunity here is to convert some of the appraisal wells into early development. And I would anticipate that if we get really positive results out of this basin overall, that we'd be very encouraged to commit a fair bit of capital to get some early development up and running. And I would say, 5 years would be a reasonable expectation, something in that order. But the market is going to be crying out for this. So if we're incentivized and we get some support from the government and potentially some partners with capital to accelerate that, it could possibly be accelerated, but let's not get it too far ahead of ourselves. What would I expect as a value uplift for stock price? Man, I won't even comment on that. Only that the size of the prize here is huge. So I'm not going to put an upper limit on where we think this could go. With a successful test coming up, I think this is going to be a very valuable stock. Will a further cap raise be necessary? We'll need more capital into the future, yes. Whether we do a cap raise or not is another matter altogether. I think there are many options for us. Principal among them, we're 100% holder of this, so it's very likely that we'll get a lot of industry interest in this, and if someone wants to come in and take a piece of this, they'll be able to contribute some capital to our future operations. Are we, James again, are we in a race with, say, Shell, Santos or Elixir? No, we're not in any sort of race. A rising tide floats all boats. So I want all of the players in this basin to be successful because it will point the way towards a really big resource available for Australia. And I think that's going to be critical to our economic well-being and critical to supplying the markets and keeping manufacturers with a resource that they can use in an economic way. So no, it's not a race. We're all in a race together to get new resources into the market. Another question, have you seen any interest from major oil and gas groups? Short answer is yes, but I'm not at liberty to disclose any detail on that. What does fast track mean? Approximately, say, from date of successful frac. I just sort of gave you the timeline that I think is reasonable to expect, but remember the value uplift in the stock will come from the increasing certainty and knowledge that comes with every step of our appraisal program. It's not related to the production timelines. The time to revenue is interesting, and but the value uplift in the stock is going to take place well ahead of actual revenue. Is there an existing vertical pilot well at the Canyon 1H location? Yes, there is. In fact, we drilled the Canyon 1 well last year, and we drilled that vertical well and purposely did not case over the future potential producing zone to allow for the option of drilling a horizontal section. And so that's exactly what we've done. So we've got all the information down through that wellbore, and you can see the logs on the left of the screen there. James has given me a compliment saying great answers, thanks. So that's the last of the questions from the web. So I think, I hope that's been a reasonably comprehensive explanation of what we're doing. And sorry if it was a bit long-winded and a bit technical, but I think it's really important. The context for this investment is really significant. And I've been a geologist working in this industry my entire career, nearly, hate to say it, but you know, more than 35 years. And I've seen the development. I was working in Woodside back in the 1980s when they developed the first LNG export facility on the Northwest Shelf. And I've seen the evolution of the industry in Australia ever since. I've been involved with the coal seam gas business in a fairly direct way, developing the fields and the export facilities. So the big phases of that history that I went through, Gippsland Basin, Northwest Shelf, Cooper Basin, coal bed methane, coal seam gas in the Bowen Basin, and then the evolution across the world where the same pattern has taken place. Importantly, the US is a great analogue. They were originally conventional production out of conventional fields, often going to great risk and great cost to explore in the deep water Gulf of Mexico for the big conventional fields. And then some enterprising geoscientists understood the potential of actually this fracture stimulation and horizontal drilling, and tested drilling in the shales that were originally thought to be either source rocks or seals for the conventional reservoirs. And that turned this whole industry on its head. And shale gas, by virtue of that intersection of the technology and the commerciality of it all, has now dominated the production in the US, and shale gas and shale oil, and it's turned the US from being an energy importer and relying on supplies from the Middle East to being an energy exporter and actually exporting LNG, liquefied natural gas, to some of the same markets that Australia is supplying into Asia. So they turned them from an energy importer to an energy exporter. That's the power of the understanding of these potential of these rocks and the intersection of that technology and commercial aspects. So that's what we're trying to emulate. This is not a path that hasn't been trodden before. It just hasn't been trodden in Australia. We need it now more than ever. And I'm really looking forward to opening up a whole new province in Australia that will be a big part of our economic future. Unless there are any other questions over the internet, none on the phone, I'll hand it back to the facilitator.